On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi team, how you all doing? Let's look back at last week and then let's have a think about what we need to keep an eye on in the days ahead. A pretty difficult one last week for most share markets around the world. We saw the S&P 500 index in the US down 1%. That's the worst weekly performance since early January. I think it was the first week of this year where we saw a bigger move than that, and we haven't seen a move of that magnitude since. And most other share markets were down too. The UK market was down 0.5%, European shares down 1.3%. Japanese shares down 2.4%. They had a big fall the previous week as well. Emerging market shares were the outlier. They actually rose ever so slightly, and closer to home, the Aussie market down 1.6% and the New Zealand market down 0.8%. So there is a bit of nervousness out there. I think investors are grappling with further evidence of a strong US economy, and we'll talk about a couple of the releases from last week that gave us further clues that the US economy is in good shape. Now, that's not all bad. Obviously, a strong economy is good for corporate earnings growth, but we also want to see just enough weakness out there in the labour market and so forth to give the Federal Reserve comfort that the time is right for it to start cutting interest rates. So those two things are sort of pushing against each other at the moment. We also had some comments from some of the Federal Reserve representatives last week, and they have been a little bit unsettling. We had Neil Kashkari, who's the Fed president from Minneapolis. He questioned whether interest rates should go down at all in 2024. And then Michelle Bowman, who is a Fed governor, I think she's a permanent voting member, she said that it's possible interest rates might need to go up rather than go down. So all of these things have conspired to just put markets on edge a little bit. You've also had oil prices that have been rising because of tensions in the Middle East. And I guess you've had a very strong performance in the first 3 months of the year. So that does set the bar a little bit higher for further increases. And it means that it only takes a comment from a central banker or a stronger than expected inflation reading or a good economic release to just see a bit of nervousness creep in. Interest rates a bit higher. We saw the US 10-year Treasury yield finish the week at 4.4%. That's up from 4.2 a week earlier, and it's the highest since November. In New Zealand, the 5-year swap rate was up about 11 basis points. It finished the week at 4.4% too. Oil, like I said, rose last week. It was up another 4.5%. So US crude now sitting at about $87 a barrel, or maybe just below that. And that's about 21% higher than where it started the year. And it's at a level we haven't seen for almost 6 months. So that obviously feeds into the cost structure of a lot of businesses, and it also puts pressure on the CPI because oil is just a crucial component in just about everything, particularly transport. So if we look back at some of the key releases from last week, in New Zealand it was a fairly quiet week, obviously another holiday shortened week and a pretty quiet one. All we had was dairy prices, but at least we got some good news on this front. The global dairy trade index rose 2.7%, which is the biggest gain we've seen since February. And that was driven by a 3.4% increase in whole milk powder. So the GDT index is up 5.8% this year, and the Fonterra milk price payout range for the season has a midpoint of $7.80, which isn't too bad. We're now all looking ahead to where prices go and what next season looks like. I guess with the Kiwi dollar down around the 60 cent mark against the US dollar, that has been one offsetting factor. So even though you've seen a bit of weakness in dairy prices, the slightly lower currency does partially offset that. That was really all we had on the local front, but there was plenty going on internationally. And I was watching the ISM index in the US quite closely. And I talked about this a week ago, the Institute of Supply Management Index, particularly the manufacturing index. And if you recall, we did talk about the prospect of it potentially being a little better than expected, because that's what we saw with the flash PMIs a week or two earlier. And that's exactly how it played out. The ISM index was better than expected in March. It rose to 50.3. That was well above forecast for 48.3, and it was the first reading above 50. 50 is your break even level. That's the point where it separates contraction, which is below 50, from expansion above 50. So that's the first reading above that break even 50 level since October 2022. So very good news there. It does give us a bit more comfort that the manufacturing sector in the US, that has been very troubled over the last 12 or 18 months, is starting to get its act together and stabilize and maybe show a bit of room for improvement. The new orders component of the ISM increased to 51.4. That's a second expansion in the past year and a half, so we haven't seen it above 50 very often either. And the employment index also improved. So that was good news. Less encouragingly, the prices paid index jumped to 55.8, which is the highest since the middle of 2022. And that has added to concerns that inflationary pressures are still more persistent than hoped. So it's this double-edged sword. You can't have a strong economy, can't have better economic activity without those inflation pressures still being there. So that is a very good example of the good news is good news versus the good news is bad news sort of mentality that is weighing on markets. Everyone's happy that the ISM is above 50, that the economy is looking in good shape. All of that is good for the corporate earnings outlook. But then you think, well, hang on, that also means inflation pressures are probably higher. And that means that rate cuts might not come as soon or in the same magnitude that people are hoping for. So you've sort of got to take the good with the bad. So that was the ISM index early last week. And then at the end of last week, we didn't get these figures until Saturday morning, the US labour market. We had the jobs report for March. This was also better than expected, at least at the headline level. Wage growth in line with expectations, so that's good too. We saw more than 300,000 new jobs created during the month. That was ahead of forecast for about 214,000, and that was actually the highest we've seen in about 10 months. So that was good. The unemployment rate in the US fell back slightly, came down from 3.9 to 3.8. That was in line with expectations as well. And the underemployment rate, which is a broader measure of labour market slack, was unchanged at 7.3. Average hourly earnings rose 0.3% for the month. That was in line with forecasts, and that made for an annual increase of 4.1%, which is in line with expectations, the lowest since the middle of 2021. Still high, but coming down, and it wasn't any higher than expected. So on balance, I think that was a good report. You know, the labour market is in good shape, and we are seeing wage inflation come down as expected, but still markets weren't really sure how to take that. They weren't sure whether they should be happy about a strong labour market, or whether they should be unhappy that the Federal Reserve will see that as a reason to not cut interest rates as soon as people are hoping for. And at the moment, June is still shaping up as the first opportunity for a potential Fed rate cut. But the odds of a cut at that time have really fallen back. 2 weeks ago, they were sitting at 85, 90%. So people saw that as a done deal. Now those odds have come back to 50, 55%. So it's seen as much more of a coin flip. Markets are much less sure that the Fed will actually move as soon as that. So we'll wait and see. Anyway, on to this week. And again, we will start here at home. Big week here in New Zealand. We've got the Reserve Bank decision. This will be on Wednesday at 2 o'clock p.m. That's when you'll get it. This is not a monetary policy statement, which means you won't get the big report. You won't get the new projections, the new forecasts. It will just be an OCR decision, and you'll get a page of comments about it. There's no media conference either with Governor Orr. So we will have to settle for that brief written statement. Now, there won't be any change this week. The OCR will be unchanged at 5.5%. However, we will be watching sort of the comments and the tone and the language very closely to see if the Reserve Bank has changed its mindset since we last heard from them, which was in February. We obviously saw that weaker GDP report. And while that made a lot of headlines for pointing out that we were in recession again, the magnitude of the decline or the contraction was still very, very modest. I think it was only minus 0.1%, wasn't it? And the Reserve Bank was looking for flat. So barely any different. I don't think that will really move the dial. Be interested to hear what they think about the recent run up in oil prices, some of those other inflationary indicators that we're seeing, and just generally where they're at. I do think they will keep talking tough. I'm not sure they will give much away, and I don't think they'll be really talking particularly differently to the way we heard them speaking back in February. So I'm not expecting a lot on that front in terms of new information or a change in tone. Markets are fully pricing a rate cut, an OCR cut by August, and then they see 2 more to come before the end of the year. So that would see the OCR finish this year at 4.75 instead of 5.5 where it is now. But we'll wait and see what the Reserve Bank thinks about that. I suspect they think differently, or at least they will want us to think that they think differently. The next release that is quite relevant for the path of the OCR is the March 2024 quarter Consumer Price Index report, the CPI inflation report, and that is due next week on the 17th, I think, which is next Wednesday, I believe. And Reserve Bank projections, and we last saw them update their projections in February, so they're reasonably up to date. Reserve Bank projections see the inflation rate falling to 3.8%, the annual inflation rate, that is. Falling to 3.8%. So remember, it's 4.7 now. That's what it was for the December 2023 quarter, coming down to 3.8. That would actually be quite good, wouldn't it? It means it's starting with a 3 handle, which sounds a lot better than a 4 or a 5 or a 6 or a 7 handle. That would be the lowest we've seen since June 2021. So not far off 3 years ago. But we'll watch the Reserve Bank this week, and then we'll watch that inflation report next week. You also have got the QSBO survey on Tuesday. This is the one that's put out by the NZIER, the quarterly survey of business opinion. This will cover the March quarter, and this is always closely watched. It's very useful in the same way that the ANZ Business Outlook survey is useful. So that is something we will be keeping an eye on Tuesday afternoon, just to corroborate some of the other things we've seen lately that point to a weaker economy in many parts of the country and across many sectors, and ongoing declines in some of those inflationary indicators. So there's 2 things to watch this week: the QSBO on Tuesday, and then the Reserve Bank obviously being the highlight on Wednesday afternoon. Elsewhere, it's a busy one in the US too. We've got the US inflation report for March, the Consumer Price Index report. This will be out on Wednesday, and this comes on the back of 2 consecutive months where inflation has been higher than expected, as well as all those other indications that the economy is in very good health, like the ISM index, like the jobs report. So for March, investors are expecting the headline and the core CPI to have gone up by 0.3%, and that would mean annual increases of 3.4%. At the headline level, that would be a 3-month high, and 3.7% at the core level, which would be an almost 3-year low. Supercore inflation, as they call it, will be in focus because that's been running hot lately. A month ago, it was the highest we'd seen in 10 months. So we'll be watching that. That is the price of services, excluding energy and housing, and it's something the Federal Reserve is quite focused on. And like I said earlier, hopes for a rate cut in June have fallen quite a bit over the last fortnight, now down at sort of pretty close to 50-50, having been close to 90% a fortnight ago. So this inflation report will be quite important given where markets are at and some of the comments we've heard from Federal Reserve representatives of late. What else have we got? Across the Atlantic, we have an ECB meeting, a European Central Bank meeting, that is out on Thursday. No changes are expected, although markets will be looking for confirmation that rate cuts aren't too far away in Europe. We've already seen the Swiss National Bank cut interest rates. They were the first of all the central banks for G10 currencies to cut. It looks like the ECB will be next, as far as I'm concerned, and I think June is the likely time when they will move. The Fed may be in June, but increasingly looking like not June, a little bit later than that. But for the ECB, I think June does make a lot of sense. We've seen better progress on inflation in Europe. The headline inflation rate down at 2.4% in March, core inflation now down at 2.9%. Those figures are lower than people were expecting, and that core inflation rate, that's the first sub 3% reading in more than 2 years. So the ECB seems to be more likely to be in a position to cut than the Fed, because the Fed is still grappling with some of those hotter than expected inflation readings. So that will be the highlight that we will be watching in Europe. Last but not least, the international reporting season will begin this week, and we will hear from some of the US financial heavyweights. First up, BlackRock, Citigroup, JP Morgan, Wells Fargo, all announcing earnings on Friday. And this will be quite pivotal, I think, for the US market, because it has had a good run and expectations are quite high for earnings growth to remain resilient and continue ticking over as we've seen in recent times. So there will be a lot of eyes on all of these big multinationals and these heavyweight companies over the coming 2 or 3 or 4 weeks, not just in the US, but everywhere, I suppose, to just see whether the recent rally in share prices is justified by the earnings that some of these businesses are generating. And I think outlook commentaries will be very important too, especially with markets being a little bit nervous. So the reporting season will definitely be worth keeping a close eye on, and it will start late this week, and then it will get very busy next week, the following week, and the week after that. The US market is expected to see earnings growth of 3.2% for this quarter relative to the same quarter a year ago. So there's the March 2024 quarter that we're talking about. That will be the third consecutive quarterly increase. Not every sector is expected to see growth. There's 11 main sectors across the US market. Utilities, technology, communication services, all expected to see year-on-year earnings growth of around the 20% mark. 5 sectors are expected to see declines in earnings on a year-on-year basis. Energy, materials, and healthcare are the 3 that are expected to see the biggest decline. So lots to watch this week. It'll be the Reserve Bank here in New Zealand and the QSBO to a lesser extent. Internationally, the US CPI will be centre stage, and the ECB decision obviously important too. Plus, on the corporate front, all of those US financial stocks, JP Morgan and Co. will kick off the reporting season, and that will be a very busy period, and one that will give investors and analysts and fund managers plenty to keep a close eye on over the coming weeks. All right, thanks team. We'll leave it there. Thanks for listening, and we'll talk again soon.